Hi everyone, this is Sabrina and Jonathan, lawyers at Verity Law. Sabrina, congratulations on welcoming your second child into the world just 2 months ago.
Thank you, John. We're delighted at her arrival, but at the same time, given the current uncertainty of global affairs, we're also worried about our children's future.
As a father myself, I share that worry. And as an experienced estate lawyer, I'm sure you've already set up security for your children.
For sure I did. But as I have seen multiple children disagree over their inheritance, I decided to redo my estate planning now that I have more than one child. And today I will teach everyone how to do the same.
I hear ya. For many single-child families, like mine, the main focus is to protect the child's inheritance from being claimed by a spouse if they ever get divorced. Also, it's important that you pay off any debts so that your child doesn't need to worry about creditors coming after the estate. So, compared to families with multiple children, single-child families can expect a simpler estate administration.
True. In contrast, when there are multiple children, managing complex estate types can lead to conflicts and disagreements. Now, when I say complicated, I don't mean $1 billion estate. I mean any assets that require long-term management, such as investment properties and companies.
Yes, and when we say disputes, we don't mean that the children are already estranged. We have seen many children who have excellent relationships argue over matters like whether to keep the investment property and continue collecting rent, or sell it and cash out immediately. Similarly, children often disagree on whether to keep operating or even growing their parents' company, or to terminate it immediately and close it down and sell off the assets.
In the end, every single child is a unique individual with their own opinions. So, as a mother of two, my goal is to reduce opportunities for argument and ease their burden when managing my estate.
Very wise. Now, let's explore why managing investment properties is often complicated. Most people buy investment properties to rent it out to tenants. When the property owners pass away, the new owners, who are often the children inheriting the property, need to decide what to do with the tenants.
If the children decide to keep the tenants and continue collecting rent, they need to receive a court approval document through a probate application. Our office is very experienced in getting this probate approval, whether or not the parents have a will. Then, the children need to take this approval document and create an estate account with any bank of their choosing.
The rental payments made out to the parents who pass away can be deposited into this estate account. However, once probate approval is granted, the children need to decide if they will go on title as the new owners of the property or if they want to sell the property in the parents' name.
If they want to keep the property by going on title, they must first reapply for a new mortgage. If there is an outstanding mortgage owed by mom and dad, this reapplication should be done as soon as possible after the parents pass away to prevent the bank from starting power of sale and taking the house away.
Once the mortgage is approved and the children go on title of the investment property, rental payments should be made in the children's names and deposited into their accounts. Those rental payments will then be added to the children's taxable income each year.
Of course, the children should be signing or at least updating their rental agreement with the tenant. In the very least, change their parents' name into their names as the new landlords.
Alternatively, if the children want to sell the property ASAP, then they need to give the tenant notice of eviction as soon as possible. Please consult a landlord paralegal for more information on this. You really need to ensure that the tenants move out before your sale closing date.
Passing down investment properties will result in capital gains, as long as the property has raised in value since the date that mom and dad purchased it. This is true whether the property is transferred from the parents' names into the children's names, or if the children sell the property under the deceased parents' names.
In contrast, passing down a principal residence has no tax because there is the principal residence exemption. This is the same whether the property is transferred into the children's name or if it's sold under the parent's name.
However, if the children already have a principal residence under their name, then for tax purposes, it may be better to sell the parents' principal residence, because the proceeds of the sale will be tax-free. But if the children first transfer that principal residence into their own name, then this second home becomes their investment property. When selling an investment property, there will likely be capital gains tax.
Since a principal residence can be passed down tax-free without tenants in most cases, it is a relatively stress-free asset to manage, unless there is an outstanding mortgage, of course. In contrast, passing down an investment property will likely result in taxes, and there will likely be tenant problems that the children need to deal with.
This also means children may have no choice but to manage investment properties longer than a principal residence, as it takes time to evict tenants even if you want to sell it immediately. During this longer process, everyday decisions, including cleaning, repairs, insurance, tenant management, rent collections, etc., may result in disagreements between children.
Yes, and if there are not enough liquid funds in the parent's estate to pay for the daily maintenance of the investment property, the children may need to use their own money to manage it until the tenants are evicted and the property is sold. Who is to give what amount of money can lead to many disputes.
In conclusion, estate administration is much easier if you leave your principal residence to your children, but not your investment property. A better way may be to sell off your investment properties during your lifetime.
Another benefit of selling it is that you can do tax planning. You may want to sell it during a period when you have RRSP space available, for instance, to reduce your capital gains tax. In contrast, your children would have no choice but to pay capital gains on the property in the year that you pass. Again, this tax needs to be paid in the year of your passing, regardless of whether children keep or sell the property.
Next, leaving an operating company with active business to your children would also result in a more complicated estate.
Yes, in Ontario, managing a business often means you need to deal with clients, employees, shareholders, suppliers, CRA, government, etc. It is definitely not for the faint of heart.
So, unless your children are already involved in your business, I suggest having a good talk with them before leaving it to them. You definitely don't want to give them something that will result in more burdens than rewards.
For sure. This is especially the case since directors of a company can be held personally liable for many things, such as owed employee wages. And any company needs at least one director. So, most likely, one of your children must take on this pressuring role and be subject to these risks.
Another problem is that operating companies require many daily decisions to be made. Do you stay the course or expand your business? Which client to take on, which to reject? Should you keep or let go of your employees? Should you find new suppliers and partners?
It is completely normal for children to have different opinions on those decisions, even if they normally get along great. As parents, we don't want to create sources of stress and conflict between our children.
Also, if you own a company that requires a professional license, then it's likely governed by a professional regulatory organization. For example, Ontario lawyers are governed by the Law Society of Ontario, which requires all shareholders of a law firm be licensed lawyers.
So if your children are not lawyers, they cannot continue operating a law firm, even if you choose to pass it down to them. In closing down the law firm, they would need to return all client funds held in your trust account, contact clients from ongoing cases to ensure their matters are transferred to another law firm, communicate with the Law Society and bank to close down all accounts. It's a lot of work and a lot of liability.
For sure. However, there is one type of company that is easy to give to your children, and that's holding companies. Those are companies with no active business, and their only purpose is to hold investments and get returns on them.
Holding companies are often shareholders of operating companies. This means that the money earned by the operating company can be given to the holding company as shareholder dividends. Do be careful here. Real estate management companies are often not considered holding companies because they do have to actively manage the real estate and its tenants.
Since the holding companies have no business activities, it is much easier for the children to inherit and manage. Whether they want to cash out the investments and keep on investing, there are not nearly as many decisions that must be made, hence there will be far less conflicts.
Now, speaking of investments, leaving liquid funds to your children would result in the simplest estate administration. And since everyone is taking cash, it's unlikely there will be conflicts. Just ensure your appointed executor checks with both retail and investment departments at the banks so your children will get all the funds without missing any accounts.
For that reason, we also highly recommend creating an asset list, which our firm will do so for free and update for the next 25 years when you do your will with us.
All right, let's do a quick summary. For families with more than one child, estate planning is more complicated. For that reason, we suggest leaving them assets that are easier and quicker to manage, such as your principal residence or bank accounts.
In contrast, leaving assets that require long-term management, such as investment properties and companies, would often add to your children's stress and will more likely lead to disagreements between them. As a mom of two, I want my children to be as harmonious as possible and definitely don't want my gift to them to turn into a curse.
That's for sure.
All right, that is all for today. I have now returned to work. To our clients and viewers, thank you for your patience as I took some time off to enjoy mat leave with my baby. As this will be the last child for our family, I look forward to spending more time with our clients. We will see you in our next month's video.